In the first part, we learned about the basics of stocks and bonds, when to invest in stocks versus bonds, who Mr. Market is, how to take advantage of the Mr. Market concept, and how to choose the best stock using fundamental analysis and market fluctuations. Now, it's time to add extra caution to our investments in order to stay on the safe side and reduce the risk of losing money. Here comes the lesson on margin of safety, which is really interesting and can help you have an extra cushion. Hey, curious minds! Welcome to Jay's Audiobook Summary Podcast channel, where big wisdom comes in small packages. All right, let's dive in. Lesson 5. The Margin of Safety. Benjamin Graham introduces a vital concept in The Intelligent Investor known as the margin of safety. But what is it, and how can you benefit from it? The margin of safety is like an extra cushion of protection when you invest. Imagine you're building a bridge to cross a river. You want to ensure it can support not just your weight, but much more. The extra strength you build into the bridge is your margin of safety. In investing, it means buying a stock for less than it's truly worth. It's like purchasing a $100 item on sale for $70. If the item's actual value is $100, you've created a $30 margin of safety. Now, how can you benefit from the margin of safety? Let me also explain you by simple example. Imagine you're interested in buying a classic car and the market value for this car is $10,000. However, you find a seller willing to part with it for $7,000. By buying the car with a $3,000 discount, you've created a margin of safety. You can apply this same principle to stocks. If a stock is worth $100, but you buy it for $70, you've created a $30 margin of safety. This protects your investment and gives you peace of mind in uncertain market conditions. The margin of safety is your safety net in investing, ensuring that even if the market takes a temporary dip, you're protected. By understanding and applying this concept, you can make more confident and rational investment decisions. Now that you have a basic understanding of the fundamentals of stocks, let's explore the various investment styles and determine which style suits you best. We will also discuss how you can benefit from adopting this particular investing style. Lesson 6. Defensive versus enterprising investors. In The Intelligent Investor, Benjamin Graham categorizes investors into two groups, defensive and enterprising. But what do these terms mean, and how can you take advantage of these strategies? Defensive and enterprising investors are like two different approaches to the same puzzle. Investing? Defensive investors are cautious and prefer a conservative approach. They look for established companies with a strong track record. Imagine you're like someone who prefers reliable, dividend-paying stocks that may not soar in value but provide steady income. Enterprising investors, on the other hand, are more active and willing to take risks. You're like a treasure hunter searching for hidden gems. You're interested in undervalued or under-the-radar stocks that have the potential for significant growth but come with more risk. Let's consider a simple example to illustrate the difference between these two. Imagine you're investing in cars. A defensive investor might buy a reliable, well-known brand with a history of good performance. You're like someone choosing a well-established car company with a reliable track record. An enterprising investor, on the other hand, might look for a lesser-known startup car manufacturer. You see the potential for this new company to grow rapidly and produce innovative vehicles, but you're also aware of the higher risk. You got it, right? So, how can you take advantage of these approaches? As a defensive investor, if you prefer stability and don't want to constantly monitor your investments, focus on established dividend-paying stocks. These may not offer explosive growth, but they provide steady income and are less risky. And as enterprising investors, if you're willing to put in more effort and research, look for opportunities in lesser-known stocks with growth potential. However, be prepared for more market fluctuations and volatility. You can benefit by understanding your own risk tolerance and investment goals. Defensive investors can use a buy and hold strategy with well-established companies. Enterprising investors should perform in-depth research and be prepared to actively manage their investments. The choice between a defensive or enterprising strategy depends on your comfort level with risk and the time and effort you're willing to dedicate to investing. Whichever approach you choose, the intelligent investor offers timeless principles to help you succeed in the world of finance. Graham also introduced us to a valuable lesson known as value investing, which I find to be truly logical and practical. Let's get it. Lesson 7. Value investing. One of the cornerstone principles in The Intelligent Investor is value investing. But what is value investing? Why is it important? And how can you use it to your advantage? Value investing is like bargain shopping for stocks. It involves looking for stocks that are trading below their intrinsic or true value. Imagine you're at a flea market and you spot a vintage watch priced at $20. If you know it's worth $100, that's value investing. Let's illustrate this with a simple example. Think of buying a car. You find two identical cars, but one is listed for $10,000 and the other is on sale for $7,000. Value investing is like picking the $7,000 car because it's a great deal and you're getting more for your money. Here's how you can use value investing. 1. Research. Start by researching and analyzing stocks to determine their intrinsic value. Look at financial reports, earnings, and other data to identify undervalued stocks. 2. Margin of safety. Apply the margin of safety concept. Buy stocks at a price significantly below their intrinsic value to create a cushion for unexpected market fluctuations. 3. Long-term perspective. Value investing is for the long haul. Focus on the fundamentals of a company and its potential for growth over time. Value investing is important because it's a proven strategy to build wealth over the long term. It reduces the risk of overpaying for stocks and helps you make informed, rational investment decisions. Benjamin Graham believed in the power of value investing because it aligns with the principles of intelligent investing. By understanding and applying value investing, you can identify great investment opportunities, make well-informed decisions, and grow your wealth steadily over time. Now that we've covered all the lessons, it's time to put them into practice in the real world. To conclude, let me provide you with a simple example. Imagine you're considering investing in the stock market. You decide to apply the lessons learned from The Intelligent Investor to make informed decisions and increase your chances of success. First, you start by conducting fundamental analysis. You research different companies, looking for those with strong financials and promising growth potential. Let's say you come across company XYZ, a well-established tech company with consistent revenue growth, healthy profit margins, and a solid balance sheet. Taking a long-term perspective, you believe in the future prospects of the tech industry and the company's ability to adapt and innovate. You don't get swayed by short-term market fluctuations, but instead focus on the company's long-term growth potential. Considering the concept of a margin of safety, you analyze company XYZ's valuation and determine its fair value to be $100 per share. However, the stock is currently trading at $80 per share. Recognizing the opportunity, you purchase the stock at a discount to its intrinsic or fair value, providing a margin of safety against potential market downturns. To reduce risk, you diversify your portfolio. You invest not only in company XYZ, but also in other sectors like healthcare and energy. This way, if one sector faces challenges, your overall portfolio remains protected. Emotional discipline plays a crucial role throughout your investment journey. You stay rational and avoid making impulsive decisions based on fear or greed. Instead, you stick to your investment plan and remain focused on your long-term goals. As you monitor the market, you notice that company XYZ's stock price experiences fluctuations due to external factors. Rather than panicking, you see this as an opportunity to take advantage of market volatility. When the stock price drops temporarily, you consider buying more shares at a discounted price. Conversely, when the stock price rises significantly, you evaluate whether it's time to sell some shares and take profits. By applying these lessons from The Intelligent Investor, you navigate the world of stock investing with knowledge, emotional resilience, and a steadfast focus on the long term. Your portfolio becomes a puzzle assembled with careful consideration, diversified holdings, and a disciplined approach. Remember, this example is for illustrative purposes only. It's essential to conduct thorough research, seek professional advice, and tailor your investment decisions to your own financial situation and risk tolerance. If you found this summary helpful, please hit that like button and subscribe for more book summaries and investment insights. And remember, Benjamin Graham's timeless wisdom is just a book away. Happy investing, and I'll see you in the next video.